Houston, Texas. The year 2000. A company worth $70 billion. Named America's most innovative company by Fortune magazine 6 years in a row. 20,000 employees. Wall Street's darling. The seventh largest corporation in the United States. But behind the gleaming tower and soaring stock price lay the biggest corporate fraud in American history. This is the story of Enron, a tale of greed, deception, and the catastrophic collapse that changed American business forever. Our story begins in 1985. Kenneth, a charismatic businessman, merges two natural gas companies to create Enron. At first, it's simple, a pipeline company moving natural gas across America. But Lay has bigger dreams. The 1990s bring deregulation, energy markets open up, and Lay sees an opportunity. Enter Jeffrey Skilling, a brilliant McKinsey consultant with a radical idea. Why just move energy? Why not trade it, like stocks, like commodities? In 1990, Skilling joins Enron and creates Enron Finance Corp. His vision? Turn energy into a tradable asset. Natural gas, electricity. Buy low, sell high, make massive profits. Wall Street loves it. In 1992, Skilling becomes Chief Operating Officer, and he brings with him a controversial accounting method, mark-to-market accounting. Here's how it works. Instead of recording actual profit when you earn it, you record projected future profits immediately. Sign a 20-year contract? Book 20 years of profit today. The SEC approves it. Enron's reported earnings skyrocket. But there's a problem. These aren't real profits. They're projections, promises, dreams on paper. And when reality doesn't match the dream, Enron has to hide the losses. Enter Andrew Fastow, Enron's Chief Financial Officer, a financial engineer who builds the fraud machine. Fastow creates something called Special Purpose Entities, or SPEs, hundreds of them, with names like Chuco, LJM, Raptor. Here's the scheme. Enron has debt, move it to an SPE. Enron has losses, hide them in an SPE. Enron needs to inflate profits. Create fake transactions with SPEs. On paper, these entities look independent, but they're controlled by Enron and personally by Fastow himself. Fastow makes $30 million personally from these deals, a massive conflict of interest. But nobody stops him. Why? Because Enron's stock keeps rising. Everyone's getting rich. Inside Enron, the culture is ruthless. They call it rank and yank. Every year, employees are ranked. The bottom 15%? Fired. This creates a toxic environment. Employees will do anything to hit their numbers. Fake deals, inflated projections, lies upon lies. By 2000, Enron's stock hits $90 per share. The company is valued at $70 billion. Analysts call it a buy. Business schools teach Enron as a success story, but a few people start asking questions. Fortune magazine reporter Bethany McLean writes an article. Is Enron overpriced? She asks a simple question. How exactly does Enron make money? Skilling is furious. He calls her research unethical. But the question lingers. How does Enron make money? The truth? It doesn't. August 2001. Sharon Watkins, a vice president at Enron, sends an anonymous memo to CEO Kenneth. She writes, I am incredibly nervous that we will implode in a wave of accounting scandals. She warns about the SPEs, the hidden debt, the fake profits. Lay does nothing. Meanwhile, cracks are showing everywhere. In California, Enron traders are caught manipulating energy prices, creating artificial shortages, causing blackouts, driving up prices. In 2000, California faced rolling blackouts. Hospitals lost power. Traffic lights went dark. Enron traders had a code name for it: Death Star. They would shut down power plants to create artificial shortages, then sell electricity at 10 times the normal price. On recorded calls, traders joked, "Grandma Millie, she's the one who couldn't figure out how to vote for Gore. Now she's paying for our yacht." Then on August 14, 2001, Jeffrey Skilling suddenly resigns as CEO after only 6 months. His reason? Personal reasons. Wall Street is shocked. Why would the CEO of a successful company suddenly quit? The stock starts to fall. October 16, 2001, Enron reports its first quarterly loss, $618 million, and announces a $1.2 billion reduction in shareholder equity. The SEC launches an investigation. October 22nd, Enron admits it's under SEC investigation for the SPE transactions. The stock plummets. November 8, 2001, the bombshell. Enron admits it overstated earnings for the past 5 years. $586 million in profits never existed. It was all fake. Investors panic. The stock, once $90, falls below $1. Enron is dying. December 2nd, 2001, Enron files for bankruptcy. At the time, the largest bankruptcy in American history. $70 billion in market value, gone. 20,000 employees lose their jobs. But worse, they lose their retirement savings. Most had invested their 401k plans in Enron stock, encouraged by executives who promised the stock would recover. Meet Charles Prestwood. He worked at Enron for 33 years. His retirement account, over $1 million in Enron stock. After the collapse, $13,000. That's it. Decades of hard work, gone. Or take Janice Farmer, a secretary at Enron. She watched executives arrive in private jets while she lost her entire life savings. 22 years of service, 0 pension. $2 billion in employee pensions vanished. But what about the executives? While employees lost everything, let's look at what executives made. Kenneth sold $246 million in stock. Jeffrey Skilling sold $200 million. Lou Pye, another executive, sold $270 million and bought a ranch in Colorado. They knew, and they got out. While telling employees to keep buying, the FBI moves in. 2004, Kenneth is indicted on 11 counts of fraud and conspiracy. 2005, Jeffrey Skilling is convicted on 19 counts. Conspiracy, fraud, insider trading. Sentenced to 24 years in prison. Andrew Fastow pleads guilty. Sentenced to 10 years. But the damage spreads beyond Enron. Arthur Andersen, one of the Big Five accounting firms, was Enron's auditor. As the investigation closed in, Arthur Andersen employees worked overtime. But not on audits. They were shredding documents, tons of them. One employee said the shredders ran so hot, they had to let them cool down. They destroyed evidence for weeks. In 2002, Arthur Andersen is convicted of obstruction of justice. The firm collapses. 85,000 people worldwide lose their jobs. Kenneth convicted on 10 counts. But before sentencing, he dies of a heart attack. He never spent a day in prison. The Enron scandal changed America. In 2002, Congress passed the Sarbanes-Oxley Act, the most significant reform of corporate accountability since the Great Depression. Now, CEOs and CFOs must personally certify financial statements. Criminal penalties for fraud increased. Auditor independence strengthened. Enron became a case study, a warning, a symbol. The lessons: 1. Greed without ethics leads to destruction. 2. Complexity is often a cover for fraud. If you can't explain how you make money, you probably don't. 3. Culture matters. When winning becomes everything, people will cheat. 4. Transparency isn't optional. Trust is built on truth. Today, the word Enron is synonymous with corporate fraud. From $70 billion to zero. From most innovative to most infamous. Thousands of lives destroyed. Billions of dollars lost. all because a few people chose greed over integrity. This is the legacy of Enron,